Hello, everyone, and welcome to the Wealthologist Live. I am Chris Hobart, the Wealthologist, and of course, as always, I got my trusty sidekick next to me, Jacob Woodrum. Thanks for hopping on with us today. Obviously, we are in December. We're wrapping up the year. Hard to believe that
we're here.
We're here. Just a quick note. However you celebrate, whether it's Christmas or Hanukkah or just general holidays, Merry Christmas to you, Happy Hanukkah. From everybody here at Hobart Wealth. We appreciate you being with us for the past 12 months. I feel like we gave some good information. Yeah. Now, Jacob, any exciting plans for the holidays for you?
Yeah, we're going to be doing a lot of travel, so I'm excited but not so excited. So we'll be in West Virginia to hang out with my folks for the weekend, and then we'll be in Virginia with my wife's family for Christmas, actually. Okay. So we'll be all over the place.
Oh, that sounds good. We are laid back this time because Sloan is home from college. She got home last night, which is exciting. And real quick, we got a couple of pictures we're going to show everybody. So let's see. Let's start with this one. Actually, I'm going to go full screen here. So Sloan and Blythe. And what I did, this is our Christmas card. Thought it'd be fun to kind of show everybody that. But I also had fun with doing the AI version.
I was going to say a little AI version. That's cool.
What's funny is Chip, who's new to the team here, actually asked. He's like, "So which one's your older daughter, and which one's the younger one?" And I thought, "Oh my gosh, they are 6 years apart. Please don't tell me that my youngest and oldest look that much similar in age. I still feel like there's enough. Like I look at them and I see Blythe as a 13-year-old, although she acts not like a 13-year-old. Right. We won't talk about that today. You have young kids. And I want to share a picture you shared with us.
Yeah. We went to the Polar Express in Spencer, North Carolina a couple days ago. We had a wonderful time. As you can see, who had more fun, Jacob or my two boys?
I'm sure it was your wife.
Right.
I'm sure it was your wife. Keeping track of 3 kids, huh? Oh, well, that's a great picture, and what a fun time for all of you guys to have together. Obviously Christmas is exciting. I think Corey may be talking a little bit about some holiday things today in his segment, but as we're wrapping up the year, there's obviously a lot of noise out there. As always, we got market headlines. There's talk about AI. There's the increase in interest rates. What's going to happen next year, you name it. So our goal today is kind of simple. I want to calm down the conversation, maybe make all this information useful, especially as we're wrapping up 2025 and as we start looking towards 2026. In fact, I've got the next Wealthologist Weekly, actually the one that's going to be coming out after Christmas on that Monday, is going to be focused on a little bit, I don't want to say 2026 predictions, but just a little bit forward looking towards 2026. Now, today, what we're going to cover, as usual, we're going to do our 3, 2, 1. And that's where Jacob is going to be doing the 3 and the 2. And that's where he's going to walk through 3 economic events and kind of how you're thinking about that in a 2026 backdrop. And then you're going to highlight 2 portfolios and kind of why they make sense right now and how clients are appreciating them in our plans. Then we're going to pull Corey Sundstrom up here. And I got to tell you, we are lucky to have Corey here today. I'll explain why in just a little bit, but it's great to have Corey here for this segment of the show. And he's going to be talking about financial planning topic that's just timely this season. So quick housekeeping. Obviously, today we're going to be educational. So we're going to be talking in generalities. Nothing that we're going to talk about today is going to be like personal investment advice or tax or legal advice. So if you want to talk about your specific situation, obviously let us know. We do that every day, one-on-one with folks. Right. All right, Jacob, are you ready?
I'm ready.
Let's see. I've got to make sure I've got our right thing in here for the 3, 2, 1.
Yep.
And we are actually going to move forward to the 3. So let's go ahead and get this party started.
Perfect. No, it's good to be here. And really what I want to start with, talk a little bit about 2026 and the theme of, steady growth for 2026, but not really a breakdown. So, as we look ahead to next year, the global economy looks actually more stable than I think a lot of people might expect. Tariff trade pressures are starting to ease. people's incomes are rising, after inflation. And so, it's showing that sort of sign of supporting growth. What's interesting is from a GDP perspective, growth in the U.S., we're looking at about 2.5% likely for next year. Europe, lower, around 1.2%, and then actually in China, looking at like 4 or 5%. So, in the U.S., I think growth could actually pick up a little bit in the first half of the year. We got government spending. I think it's still helping the economy. As we always talk, Chris, and we talk about this all the time. The main risk, I think, though, is the job market. We've kind of seen layoffs beginning to slowly increase a little bit, and that raises the chance, I think, that unemployment could rise faster than expected. So if it happens, the Fed has room to respond. And we've talked about this a lot, but from an interest rate perspective, I think we're going to get rate cuts in 2026.
I think did I say rate raises before? I think I said rate raises. Yeah, I meant rate cuts.
But no, definitely rate cuts. We'll see, what pace and how many. But I think the job market, the job market's going to, I think, guide how aggressive the Fed becomes with that. So,
yeah, I definitely think that the Fed is, going to slow down. I don't think we're going to start seeing those 0% interest rates like we used to see. I think that they're going to not be as aggressive as they have this year. Not that they've been super aggressive this year, but they've, how many cuts this year has it been?
Yeah, we got a couple cuts. So, I mean, and we'll see. I think 1 or 2 cuts is kind of what we're looking at.
Yeah.
Again, things can change, the data changes, but at that point, I think that's what we're looking at. That, growth and I think earnings momentum, that I think will outweigh the risks. I think, mid to high single-digit returns is kind of what we're looking at in the S&P 500 from a market growth perspective. So not a boom, but still, I think a positive environment for investors. So I think the economy may slow at times. I think it's going to be a continuation to some degree of this year, which is that back and forth, a lot of volatility. But I think 2026 looks much more like a manageable year than something where we see like this major setback.
Yeah, and I was just reading a report about that, and that's exactly what I saw. It's not a matter of are we going to have the bottom drop out,
right? But
the reality is a 10% correction. That's the market. So don't be shocked if you see a 10% correction that comes and hops up. I mean, that's just how it goes. But the thought that everything's going to fall out from the bottom, a lot of folks are looking and saying 2026 does not appear to be that year. Again, stuff happens.
Right.
But right now, that's what it looks like.
I think that's smart. Second point I want to talk about is AI. So the theme here is you own AI even if you didn't mean to. And artificial intelligence, it's been really the biggest market story of the past few years, as we all know. But and there's really no avoiding it. So we've got a really good slide on this. But if you own the S&P 500, you already got a pretty large AI investment built in. So what's so interesting about this, and this chart shows this, but in 2025, so in this year, companies tied to AI made up right at 40% of the total S&P 500 market. And if we look at that contribution to S&P 500 performance at 67%, it's generated roughly 2/3 of the index's gains. And so that just means, most investors, all of us here, right? We were already heavily exposed, really, whether we realize it or not. So I think what's changing now is that, AI we've thought about it for so long about, it's NVIDIA and it's Microsoft. It's just a couple of these few big tech stocks, but it's really starting to spread into other areas like software and data centers and industrials. And that just gives us as investors more ways to participate without having to put all of our eggs in one basket.
Well, and you've been talking about that for a while, which is kind of that the broadening out of what AI actually means, and the different ways to invest in AI without being AI centric, and I think we're starting to see that, which are the ancillary things of that happen around AI, power sources and things like that.
Right. And so I think that's exactly it, Chris. And so I think AI, it's already a big part of our portfolios, and so I think the real question is not whether we want to own it, but let's own it in a smart, diversified way.
And that's, I kind of look at that even with like cryptocurrency too. You start to see cryptocurrency a couple of years ago kind of began to be baked into different companies. Not quite like AI though. AI is at a different play though.
Yeah. So the last topic that I'll spend here is it's still the AI theme, but really talking about just the big spending that we're starting to see. And we're all probably familiar with Top Gun, right? And so I like that line in Top Gun where he says, "Your ego's writing checks your body can't cash." And that's kind of what describes, I think, right now the recent shift really in how markets are viewing AI spending. And again, we've got a really impactful, I think, slide on this. But for a long time, investors really have kind of cheered the spending that we've seen in AI. But late this year, enthusiasm's starting to cool because the costs are really becoming enormous and the payoff is still a little bit uncertain. So if we look at this chart, this is showing us, spending by the biggest AI players: Amazon, Microsoft, Google, Meta, Oracle's in there too. But what's crazy is that they're expected to exceed spending of $470 billion, which is, that's $500 billion. It's just incredible in 2026. That's up about 70% from a year earlier. So again, you can see Oracle jumped in on that graph as well. They're also taking on more debt. But I think the reality with this is that, stock bond investors kind of starting to ask the tough question of, lenders want higher interest rates. We as equity investors, we want clearer profits. And, the market pullback that we witnessed just last month, it's kind of a good reminder that risks haven't disappeared. I think they were just being ignored for a little bit. So Fed's leaning towards easier policy. Other sectors, I think, are offering growth at lower prices. Kind of the idea, which again, we've talked a lot about, Chris, is, this broadening out impact. I think broadening out is what we're seeing. And it really does allow us, I think, to say, okay, how do we rebalance a little bit? How do we diversify further? We still want AI in our portfolio. It remains a very powerful, I think, long-term investment theme. But, diversification and discipline, it's important. It's really important for us.
And that's it. I mean, the problem is AI has been such a driver this past year and the year before that, sometimes you get folks that want to, when we see this, want to run away from diversification and just kind of chase. And I get it. It's just that's also where you open up yourself to risk, because something turns, a bubble pops in some form or fashion, and you're left exposed. Not that we're calling for something like that, but it's more a matter of just being smart. Spreading that risk out.
Yeah. Speaking of spreading the risk out, well, let's talk about the two portfolios.
Okay, there you go.
So the first portfolio that I'll highlight, and I've highlighted this a couple times this year, but and I was kind of struggling. I wasn't sure if I wanted to highlight it again, but I decided to talk about it again because it really is, I think, a strategy. Again, as we look at where we're at right now and as we move into 2026, I think it continues to make sense. It's our dynamic buffered S&P Select, which just means we're going to track the performance of the S&P 500, but the difference is we're building in, this buffer against losses. So the buffer we can customize if we want some downside protection. Of course, if we're putting in some protection on the downside, we know that's going to limit some of the upside, but it still allows, I think, for competitive growth potential. Really good fit, I think, for somebody who wants to stay invested in the market, but we're just not wanting to take on the full risk and volatility of what the market is.
Yeah, and I think that's the key. It's like, look, we've got plenty of clients that still can take risk, but don't want to take the full risk, and this allows a little bit of a buffer, right? And I mean, that's exactly what we want to see. You still get to experience the market, you still get to do that, but when the market crashes, you do give yourself a little bit of play. And I think that's a nice thing when I think about investments, specifically what you're working with and building and structuring and finding. We can have the conversations with people that have all different sorts of risk tolerances. There's some people that say, man, I want to be all the way in there. That's great. You want to be all the way in there, then let's make you tax efficient. In this case, you want to be all the way in there, but you also want to make sure that you have some sort of downside protection. It can be done.
And it just allows us to not have to try to time the market. We know we're invested. We know what our outcome can be or could be. And it's just, I think it gives us the ability to control the narrative instead of the market controlling you. And then the second portfolio that I want to highlight is really just a high yield dividend factor strategy. I call it the golden goose. I've talked about this before. I think we've put out an article or two about it. But when we think about stock portfolio that pays dividends are simply payments that the stock or the company makes to us as shareholders. So it's kind of like getting a bonus for owning the stock. We don't have to sell anything. The income comes to us, and our investment stays intact. And so, again, I think of it the story of the goose and the golden egg. Aesop's fables, high quality dividend stock. That's our goose, and we keep the company, and it keeps laying golden eggs, and that's really the steady income. Yeah. And so, it's just we're going to focus on companies that have strong balance sheets, reliable cash flow, and they pay those dividends, and hopefully they grow over time for us. Because we don't. And I think the one thing that's important, we're not going to just go and try to chase these big payouts or these high dividends, because that oftentimes tells us the company could be at risk. So it's really more about quality and sustainability and patience, and we want to keep that goose healthy, so the eggs keep coming year after year.
Yeah, and we compare this sometimes to almost like real estate, right?
Yeah.
You buy the real estate knowing that some appreciation can happen. But then, very importantly, if it's rental real estate, you're collecting that rent on a regular basis. Right. And just as with rental real estate, if for whatever reason that house starts going downhill, the tenant's going downhill, or the tenants are not as reliable, it is not as great of an investment. But if you keep a good house, good tenants, and have a consistent adjustment upward in the dividend or the rent, I mean, it is great. It's just when things turn around, the nice thing is with a portfolio, you can sell a stock quickly.
Right.
With rental real estate, it might take a while.
Yeah.
Not that I have a piece of rental real estate that we're trying to sell right now, because all of the bad stuff did happen, but that might be the case right now. And we're sitting there saying, oh, I wish it were like a stock that you could sell like that, right. But it's not. Jacob, well, I appreciate your insight. I wish you a Merry Christmas. Hope you and the boys and your wife have a great one with the family, and we'll see you soon. And now we are going to take a moment, and we're going to welcome Mr. Corey Sundstrom to the show. And Corey, good to have you here.
Hey, glad to be here.
Yeah. So I mentioned earlier you were sitting over there. I just ruined the magic, didn't I? Everyone's like, where Corey just zoomed in? Where did he come from? He was just sitting over there. That's just how it works. We're pretty simple over here. But Corey, I don't know if you want to share any news. I mean, people kind of know some news, but there's kind of some big news.
Yeah, no, leaving tonight for the hospital to have our first child. So next couple of days will be an eventful couple of days, hopefully a smooth couple of days, but we're thrilled and excited.
Yep. Yeah, I was thinking about that, and I thought, man, this is the doctors. They just don't want to be called in on Christmas.
Yeah, they're trying to get it done before the big day.
Let's go ahead and get these. It's so interesting to me, though, Corey, because I think of your life and my life, and I've got a 13 and a 19-year-old. We just sent ours off to college, obviously, Sloan, this past year. And it's so interesting because we're on two very different spectrums of, I'm pushing one out of the nest and you're welcoming one in. And just what an exciting time. And also to so many of the clients that have sent just messages to Corey, we've had some people stop by with gifts. I really appreciate it. It's great. Yeah, I love to see when clients do that, because it means a lot, because I know you give a lot to clients. And
I know you're in a different stage of life, but I do want to let you know that Renee did say that you guys would be willing to babysit at any point in time. So I just want to point that out.
She's a liar. All right, we do have a picture that we will share. Now, if we can be true. I asked Corey if he would do holiday pictures, and he said, our holiday pictures this year were kind of goofy. And I've seen the pictures, and they did some fun ones, and I got to tell you, they were funny. But Corey said, I'd love to show pictures of me and my dad fishing, because that was something else that was really meaningful. So, quick shot. Tell us about what you guys.
It looks like I really got that fish by the head there.
I know, right?
Trying to breathe. No, my dad and I went about a month ago up to Linville to do some fly fishing, something he really loves to do. He's a lot better at it than I am, by the way. We had a great time, as you can see, caught some good fish, had some really good weather. So, I don't know, it's always nice to get away from the city a little bit and get a breath of fresh air.
Yeah, that's
always
great.
Helps when you catch something, too.
Yeah, well, I have given Corey my guide that's up there, and my guide, I swear that they just go and buy fish and put them right in front of you sometimes, which makes it good. All right, so let's get on to the one. And as we talk about the one, you're going to be talking a little bit about kind of gift giving during the holiday season. And I think that's a great one. I actually just talked a little bit about this in the Wealthologist Weekly this past week. I know you've got a little bit different of a take that we're going to be looking at with that. So dig in.
Nobody loves nobody more than you guys love getting unsolicited parenting advice from a guy that has yet to have his first child. So I'll reframe this as financial planning advice so you don't take it that way. But I want to talk a little bit about holiday gift giving. So when we talk about kids and grandkids especially, a lot of that has gotten really out of hand over the years. Christmas and Hanukkah, the holidays in general, have become a very materialistic holiday over time.
A little bit.
And so I just beg you during the holiday season to try to be intentional about your giving. We're going to talk about a few things, but I want to talk about kids first, just because this is, something that we're going to be going through pretty soon here. And that is that usually, especially with younger kids, they typically just enjoy the simple things. So when you think about toddlers or infants or even other really young children, I saw a video the other day that popped up on my social media, and this person kept handing their toddler two different things: an expensive kid's toy and then like a kitchen spoon, or like all kinds of kitchen utensils and expensive toys, and the kid would always grab the kitchen utensils. Mm-hmm. So it's interesting because in the beginning of our lives, joy is not connected to things. It's connected to experiences and relationships with people around you. And that kind of fades away. That gets conditioned out of us a little bit over time. And so I just encourage you, as the holiday season comes around, to really, I'm not saying don't give gifts, but just put some thinking behind it. You look at research that's happened over the years, and a lot of it points to happiness stemming from gratitude rather than acquisition. And so what I mean by that is the more grateful somebody is for what they already have, typically the more happier they are, and the more that they're attempting to acquire things in their lives or buy things, we know that doesn't necessarily breed happiness.
Yeah. And one thing I talked about in the Wealthologist Weekly this week was experiences.
Yeah.
I will say, and experiences can be tough because they always sound great, but sometimes they're a lot harder to pull off. But it is that memory, and I got to tell you what, ask your kids. I mean, they will not remember what you got them last year, most likely, but they will remember that cool vacation that you went on or that cool thing that you did. And I think that's the important thing is really looking. You're going to spend the money one way or another, right? Mm-hmm. So figure out a way to make it have an impact. And again, I'm going to encourage you to go back to the Wealthologist Weekly. It's at the Wealthologist YouTube channel. Watch this past week's. I think it's really impactful in giving some additional thoughts as to kind of creative gift giving when it comes to finances.
And I love the experiences idea. I mean, I'm always a big proponent of that. But
you took your dad fishing, right?
Yeah. But I mean, I think even in the experiences, the funny thing is, especially with really young children, if you go, let's say you go on a cruise and you take them, it's really funny. You should ask what their favorite part of that cruise was, because it's very likely that the thing that they'll mention was the free thing that was there, like swimming in the pool or like going on a bike ride. It won't be that we had an expensive steak dinner.
Now,
and so,
just as an aside, or have you ever been on a cruose?
Yes.
Okay, I was going to say,
I have. Been a while, but I have.
There's nothing free on a cruise.
That's true.
you paid for it.
But no, the point is, like, it's especially with young kids, like the things that they remember and the things they enjoy may not be the thing that cost $1 million.
I got to tell you, Blythe, it's like every time we hop in a pool, she remembers, like, oh, remember when you were throwing me in the pool? And her thought of how high I could throw her grows by a foot every year. She's like, oh, I remember when I was this age, you could throw me like, But it's things like that she still to this day, at this age of 13, she still remembers, and she still wants to stand on my shoulders and see what we can do, and
you won't correct her that you were able to throw her 20 feet. I'm sure
you've seen the guns. You've seen the guns.
And so, look, as we head into this, always, I think it's always a good exercise to practice gratitude, and a lot of us do it at Thanksgiving when we're around the table, telling what we're thankful for. But it's always good to come back to that during the holiday season. I want you to think about gift giving kind of like a barbell, and you want to be on either side of this barbell. Either, and this goes for anybody, not just kids. On one hand, there are the low-cost, thoughtful gifts that really tell somebody that you know them. And then on the other end are the big, grand gifts that are memorable. and a lot of those can be experiences.
Yep.
And what you want to try to keep from doing is giving gifts that are in the middle. Somewhat expensive gifts that everybody's going to forget a year from now.
Gifts for the sake of gifts,
right?
Which we've all received those.
Yeah, and we all give them still.
Yeah.
Right? So it's the fact of the matter. But as you head into this season, the financial part of this, start with a budget. Make it a game. You say you're going to spend, a couple $1,000s on Christmas for all family members. Then it becomes a game to say, how creative can I get within that budget to show people that I really know them? And what are they going to remember 5, 10, 15, 20 years from now? And let's try to keep from giving just a gift. Because fact of the matter is, I think 75 to 80% of the gifts we're going to give somebody else in the holiday season, especially kids, they're not going to remember it.
Yeah, that's true. Yeah. It's the other good thing about giving experiences is you can do like a gift card for an experience,
Yeah.
and you give that to them and say, hey, we're going to do this, and then you mysteriously forget to do it, and then you actually don't have to give a gift. I kid. But if my brother-in-law George is watching, I realize I owe you a fishing trip from when you turned 50, and I kind of skipped out on that, and it's been a year and a half, so I apologize. Hey, let's go fishing, bud.
Yeah.
I've got a great guide up in the mountains. All right, well, Corey, before we wrap, in the past, what we've done is we've done the quickfire Q&A,
Mm-hmm.
and that's where we kind of take 3 questions. What I want to do this time is you always do a good job of telling different client stories of what's going on. And I want to take a quick client case study, where we remove names and specific details. But the planning situation can remain very real. So I want to tee up a situation of something that we've talked about, and really what the client's concerns are, but what we were able to do and you were able to have conversations around. So,
Sure.
So I know the couple we talked about before, they were mid-60s, recently retired, they saved well, quite frankly, in a good spot overall, but they came in with that, I just want to feel steady vibe. And I think sometimes you get that way, you get a little bit nervous about everything going on. Portfolio-wise, they were invested in familiar places, broad indexes, bonds, a few positions that they held for a long time. But they said something that we heard a lot lately, and kind of heard a bit from Jacob as well. It feels like the market is basically just AI, and we're not sure what we actually own. So
yeah, and that really creates 2 big concerns for most people. One is you think about something like AI, Chris, and you hear it on the headlines all the time. If you watch any of the market financial stations or channels, you're going to hear people barking about it all the time. And I would say your average person in a broadly mixed portfolio probably has no idea how much of something like that they own. Because we're holding a bunch of, maybe one fund or a bunch of funds, and we don't really know what the makeup of them is. And so the second concern that comes along with that, and we don't know the makeup, is, okay, well, if any of these headlines play out and something happens, we have a bubble or a correction or something worse, how's it going to affect me at the end of the day?
Yeah, and this specific couple we're talking about, they weren't asking for fancy. They basically said, we're not trying to hit home runs. We just want a plan that we can stick with and have confidence with that.
Yeah, exactly. So what we do in a situation like that is typically, one, we're going to try to simplify the picture for somebody. So let's unpack everything and see exactly where the exposure is so that we understand how much we're holding. And, you use AI as an example. It's easy to point to that in a portfolio because it's going to be NVIDIA or Google or the big tech companies, essentially. So let's understand what's actually in there. But let's also set some guardrails around it. So it's our job with everybody we work with to understand how they feel about risk. And we want to make sure that we're investing in our portfolios in a way that matches up with that and gives some room on the upside and the downside to move without getting an uncomfortable feeling. So it's our job to understand that and really explain that to the people that we're working with. But the third thing that I think is the most important thing here is we all get sucked into the daily. So we get sucked into the headlines. If something doesn't go right for a week in the markets and we're really zoned in and watching CNBC or whatever other channels are out there, we lose sight of what's important. And we always have to come back to, why are we doing this? The majority of us are not doing this to make return. Yes, returns are important, but we're doing this because we want to make sure retirement is sustainable. We're doing it because we want to, have great holiday experiences with kids. There's other personal reasons. And if we can back up and reevaluate those, a lot of times that helps us understand why we're situated the way we are in our portfolios and helps us from overreacting in moments where, maybe it's just a blip on the radar in the market.
Yeah, I think the concept here is that we're bringing it back to real life, right? I think sometimes you can glaze over and it's like it's all about market performance, all of that. And it's like no, let's actually see the impact of that. Right. And I know in this case, the outcome isn't now let's predict 2026, but instead they left the office. Okay, we get it now. We know what we own, we know why we own it, and we know what the plan is if the market gets bumpy. Which at the end of the day, that's really what they needed to hear. It's not a matter of we can't take the bumps. It's just, hey, let us understand what the bumps look like and how bumpy is it going to be.
Yep, makes sense. So look, it's not about perfect forecasts. We'll never give you a perfect forecast, and if we do, we'll be very happy about it. But nobody can do that. So it's not about being perfect. It's just about making sure that we're fulfilling the long-term priorities that everybody has in place.
Well, that's great. And so, you might be sitting there and this scenario might sound familiar. You might have a specific scenario that, you're curious about. Do me a favor, just shoot us an email, heyhobart@hobartwealth.com. If you do that, we can take some time to answer your question more specifically to what your needs are and go from there.
Yep.
All right, Corey. My guess is you are going to leave here, probably wrap up a little bit, and then your priorities are going to change a little bit.
Yes, I got my last full night of sleep in for a while last night, so I soaked that up as much as possible. Had a nice, quiet cup of coffee this morning, and we're on to the next adventure.
Well, I wish you and Lizzie luck. Keep everybody in the loop. We'll let everybody, our clients and everything, know as well. But good luck and Merry Christmas to you and your family.
Merry Christmas to you.
All right, folks, we are going to move on to the next segment, and the next segment is one that I always enjoy and have a good time with. It is called Hey Hobart, and this is where we take a client question and we answer it, pretty plain and simple. And this week we've got a question from Cindy in Wilmington. She said, "Hey Hobart, how do I know if I'm taking too much risk in my portfolio in retirement, if already here?" Or if retirement is already here. Sorry about that. Well, I got to tell you what, that's a great question. And the simple way that we look at it, right? If a normal down market would force you to change your lifestyle, huge red flag. And when we talk about a normal down market, 10% is kind of that, what could be expected. Anything above that, towards that 20% or something like that of a loss in the market, that's where we're starting talking about a more substantial down market. But if that changes your perspective on life or your living situation, you got to make a change. The thing is, if you don't have a clear plan for where income comes from during volatility, that's another red flag. Also, if your portfolio feels confusing, you don't understand it, it's kind of hard to feel confident. So clarity also matters. The thing is, and we talked about this in that scenario when we were talking with Corey, right? The goal isn't to remove all risk, because risk exists. The goal is to make sure that the risk that you're taking is intentional and that your plan has guardrails so that you can stick with it. And that's exactly it, intentional and aligned with the plan. So that hopefully answers your question as you're talking about taking some risk now that you're in retirement. All right, folks. This is where we're going to land the Wealthologist live plane for the year. Quick recap for you. Big picture is looking forward, steady growth, not perfect growth, not panic, but just a cycle that still deserves some discipline as we head into 2026. Also, we talked a little bit about AI is already in most of your portfolios in some form or fashion. So the real job is owning it in a smart and diversified way and not being overexposed in that. Now, on the planning side, Corey talked a little bit about how the holidays can be meaningful without really being stressful. Keep that budget first, think about experiences, and then skip the forgettable overspend, which we've all been guilty of that at some time. Now, if you want help applying any of this to your situation, your income plan, your portfolio guardrails, or maybe it's year-end decisions, just reach out to us. We're happy to walk through it. Just reach out at heyhobart@hobartwealth.com, and we're here for you. And again, Merry Christmas, Happy Hanukkah, and Happy Holidays from all of us here. We hope you get a little bit extra time with the people you care about, and we wish you a happy and healthy new year. 2026 is right around the corner. Thanks for being with us. We appreciate you, and we'll see you next month or next year.